Hello everybody, welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy, I'll be presenting. As we get started, let's just do a quick systems check. If you're hearing me clearly and seeing my screen all right, just type OK in the chat box. Okay, great, looks like we're up and running fine. If anyone has any issues as we go along, feel free to let me know. As always, keep in mind that there's risk with each trade that you take. Obviously, no one trade is guaranteed to profit. So you want to manage risk in a way that makes sense for you. And keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. In mentioning that, we will go over some easy ways to do risk management with the advanced tools and functionalities that are available in the order window on our web trader and app. It makes risk management side of things quite a bit easier. And as we go through, there are other tools, obviously, that we'll look at as well that makes your fundamental analysis, technical analysis easier, with an emphasis on the fundamental analysis today. Now, if we log in from the upper right corner here, we'll be in the web trader. And also, you'll notice that if you download our app from the major app stores, depending on which phone you're using, the Apple App Store, the Google Play Store, the AvaTrade app has the same functionalities and features as we're about to use in the web trader. And both of them work, whether it's MT4 accounts or MT5 accounts. You can trade on both from our web trader and our app. And you can easily switch between your accounts just with a simple click. Now, today's focus is fundamental analysis. So I think a good place to start would be the economic calendar. And just to do a quick overview of what's happened recently in the markets, fundamentally speaking, out of the US in particular, there's been a big focus from investors on the inflationary data. When might the US start to show a bigger turn of inflation coming down? And I think that turn was made with the latest CPI data that came out this week out of the US. All of a sudden, the data was much lower than expected, kind of across the board on a few different numbers that came out. And that really put a bullish movement into the stocks, the equities, some of the commodities as well, with the fact that things are slowing down enough in the US that maybe that puts in play still this year for the US to start possibly lowering interest rates back down. The backstory on the interest rates in the US is they raised them again and again and again and again to try and bring down inflation, because inflation was out of hand really globally, but also largely in the US. And while they paused interest rate hikes after about 10 increases or so, they've yet to lower interest rates back down. And that makes doing business more expensive. Home loans, car loans, business loans, it really puts a damper on things. And so, the stock market in particular is very reactive to any idea that interest rates could come back down. And by reactive, I mean in a positive way. So that CPI data is showing a slowdown in the US, which typically is bad news when there's a slowdown, was deemed good news in anticipation of potential rate decreases, maybe as soon as the coming quarter. But we'll see how that goes. But that created a lot of optimism on the markets, which seems to have carried over into other markets, European, Asian, etc., and has carried over into today so far. So that could change. There are more announcements coming, and I think that's a good place to start. Going into the idea that there's optimism, but let's see what's on the schedule today in terms of economic announcements. So if we take a look at the discovery menu found here, we can go to the economic calendar. And for anyone who's new to these webinars that I do, and maybe you've seen an economic calendar before and you're thinking, well, what's the big deal? Our economic calendar is backed up with a lot of data that it does data crunching for you, looking back at the last quarters, last year even, of announcements for any particular announcement, and showing you what direction did the different currency pairings move in relation to that announcement. And specifically, you can qualify if the announcement came in better than expected or worse than expected. So we look, first, let's go to today's date. We look at this economic calendar and we see the previous numbers when the announcement came, looking one time back. We see the forecast numbers, what's expected this time, and then we see the actual numbers from today. Okay? And if we scroll down, we get past this red line. Now we're looking into the future to announcements that haven't yet occurred today, but will soon. So if we look at the US announcements here, which have not occurred yet, we can start to dissect which announcements, using these tools over here, which announcements give maybe a percent chance advantage based on looking at the past statistics, that if the numbers come in a certain way, maybe you can anticipate a certain percent of the time that certain currency pairings will move a certain distance in a certain direction based on those announcement numbers. Okay, and so let's go through a few of these. And one area that's been a big focus has been the job numbers out of the US, whether it's hiring numbers like the non-farm payroll, which came in weaker than expected, like the CPI data recently did, again, creating optimism out of bad economic news. Usually when jobs numbers miss the mark, that's usually bad news for the economy, but in this case, it was deemed good news because maybe more likely to see rate decreases if things are slowing down in the US. So the jobless claims numbers, okay, this is not hiring, this is people filing for like unemployment claims, unemployment numbers that come in where people are asking the government for free money because they lost their job. Okay, so initial jobless claims. The higher this number is, the more it means maybe things are slowing down in the US. And the lower these numbers are, it means the job market is still strong if there aren't very many jobless claims. Okay, so it's kind of the reverse of when it shows the non-farm payroll hiring numbers. This is jobless claims numbers. Okay, so if we take a look at this one, which comes in my time 3:30, would be in your time zone as you look at the web trader. Okay, so then I click on this volatility tool over here, is my favorite one, and there are a number of different views you can have with these different tools. But the volatility tool, if I look at maybe your favorite currency pairing to trade, or you look at a few of them to see which one has maybe the strongest statistics that you like, I'll leave it on Euro USD. Tends to be a pretty stable, somewhat less volatile pairing compared to like USD JPY or GBP USD. The Euro USD tends to be highly traded, have a high volume of trading, etc. So as we look at this Euro USD pairing, and again, you can switch to any USD pairing that's listed here. We can look at different time frames back. I'll leave it on 4 hours after the event for now. And we can look at all of the events, which came out 50-50. That doesn't surprise me because we're not qualifying whether these numbers came in better than expected, worse than expected, or as expected. So half went up, half went down when the numbers came in. But what's interesting is if we start to qualify this, and if these numbers come in below forecast, meaning better than expected, right? Below forecast means better news than expected because there's less people applying for jobless claims. So it means the economy is still strong. If this comes in below forecast, we see the USD strengthen, okay? That creates fear right now on the markets. USD strengthens, stocks pull down, maybe even some of the commodities pull down as the USD strengthens. Why is that? Because if these numbers are better than expected, in this case, lower than expected jobless claims, then the expectation is they're not going to be able to lower interest rates yet in the US because the numbers are better than expected. And so you see the USD strengthen 2/3 of the time and pull the euro down. And you see the ones that went down were much larger than the ones that went up. So not only did it drop 2/3 of the time, but even if you were selling on the ones that went up in those first 4 hours, they barely went up compared to the ones that went down. On average, the drop was much larger than the average rise. So not only did it go down 2/3 of the time it went down a larger amount on average than the ones that went up. Okay, so more movement down and more often down. Okay, larger movements and more numerous movements down, less movements and smaller movements on average up if this comes in below forecast. Means USD strengthens when jobless claims numbers are better than expected. Kind of makes sense. If these jobless claims numbers come in above expectation, meaning worse news than expected, more jobless claims than expected, all of a sudden we see the opposite. 75% of the time, the USD weakens against the euro and the euro climbs in the 4 hours after the event. We see the range movement listed, over 41 pip range movement. One time it dropped, 3 times it went up. Okay? The largest one that went up is larger than the one that went down. The other 2 were smaller, but on average, if you add them together, there's more movement up than there is movement down in those 3 climbs compared to the 1 drop. So you could say, well, yeah, but that's after the numbers came in. Maybe it's too late. You see the numbers and the movement goes so quick you miss it. You know, if we look 5 minutes after the announcement, the average range movement is only 11 pips. Okay, 11 pips range movement. After 4 hours, the range movement is 41 pips. Okay, we see particularly on this one move, you'd have made more than the other 3 movement combined. Okay, and again, when we switch it the opposite direction, 2/3 down after the numbers came in, average range movement less than 11 pips, and 2 of them were up. So you still have time to place the trade in the first 5 minutes. According to these statistics, nothing dropped much past 10 pips. And after 4 hours, the average range movement was over 47 pips, with one of them reaching over 53 pips drop, another 45 pips, another 13 pips. Okay, so even in the first 5 minutes, you have time. In the first minute after you see the numbers, first 2 minutes, it doesn't take so long to place a trade. If it's within the right range movement and you're confident in the directionality for the longer time period, perhaps you make a trade. And again, this is what we call data-driven trading. It's not guessing. It's not a hunch. It's based on statistics from the past announcements. Okay? Some announcements have a more clear statistical advantage and directionality based on how the numbers come in than others. The jobless claims seem to be the focus with this cluster of announcements. They're all at the same time, these ones here. The jobless claims has statistics that seem easy to follow based on how the jobless claims numbers come in. If we look at the manufacturing data, it's less clear. The focus seems to be on those jobless claims because with the manufacturing data, if this comes in above forecast, okay, it drops 2/3 of the time, makes sense. Above forecast, better than expected manufacturing data, USD strengthens 2/3 of the time. Same as that jobless claims data. If it's better than expected, the USD has been strengthening. But with this one, if it's below forecast, okay, it's 50-50. So not as distinct of an advantage when this comes in worse than expected as the jobless claims numbers showed. Okay, but certainly there's a doubling effect potentially. If this comes in better than expected, above forecast, you get dropping 2/3 of the time. And if at the same time, the initial jobless claims come in better than expected, which is below forecast, is better than expected, also drops 2/3 of the time. So if those come in like that for both, with the manufacturing data, the manufacturing index data coming in better than expected, which would be higher than expected, and the jobless claims data coming in better than expected, which would be lower than expected, then you might even be more certain to make that move that you think the USD could strengthen, because both of those seem to have that effect. Okay, so this type of trading plan is data-driven, and you can put it together on Saturday, Sunday, over the weekend, what your plan will be. If the announcement comes in like this, then I will trade like this. And it's based on data, and you just wait to see what the numbers are. Okay, and obviously you want to make sure you get an entry point you like. Okay, any questions on that? How to use this information to put together a trading plan, and really you can do it for the whole week. Over the weekend, take a look, Monday, Tuesday, Wednesday, Thursday, Friday, which announcements look like they have the best statistical advantage based on whichever way they come in, and you have a plan. If it comes in this way, in this case, manufacturing data comes in better than expected, I'll sell. If it comes in worse than expected, I won't trade on that, because the statistics show 50-50 if it comes in worse than expected. But if it comes in better than expected, it shows an advantage to sell on Euro USD, for example. And with the initial jobless claims, if it comes in better than expected, you trade one way, worse than expected, you trade the other way. It shows a statistical advantage in both directions, depending how it comes in. Okay, I don't see any questions popping up, but if they do, I will address them. And we could go on. We can follow this same type of plan and look at tomorrow. And we don't have to look at every announcement within this session, but you'll see there are announcements out of the US tomorrow, a high-level announcement here. We see a high volatility announcement out of France here, unemployment rate. We see industrial production numbers coming in. The medium level announcements, some of them will move the market as well. You can check those announcements and the past statistics. How did they cause movements? We've got CPI data out of initial rate increase out of the European Union here. Inflation rate and CPI data that also can have a huge effect, okay? The Euro area also has been dealing with inflation fears and really coming out of it, I think, better than the US has. But still, there's a focus out of the Euro area on CPI data, inflation rate, core inflation rate, and you can check those announcements and see if these come in above forecast, what has happened? Well, it only happened once, but above forecast, it was a bearish movement. The Euro dropped. Below forecast, hasn't happened. But if it comes in matching forecast, that's happened. The majority of the announcements match the forecast, and 2/3 of the time, approximately, the Euro is pulled down against the USD if that happens. Okay, so statistical advantage to sell if this comes in matching the forecast. So it's a plan you can have for these different announcements ahead of time, and then if you're able to watch the announcements as they come in, you can make your moves accordingly. Okay. The Canadian announcement as well, even though they're medium level, you can see good statistical advantages sometimes on not just the high level announcements, but the medium level. And have a trading plan for really each day of the week on different announcements that you think you can gain an advantage based on how those numbers come in. Okay, and at any point, if you have questions, please, you can type them in. I'm happy to address them as we go. Now, another tool we can use, very simple tool to use, but powerful. We can go to the Market Buzz, and we can pull up different instruments, and all the instrument classes are here: stocks, cryptos, currencies, commodities, indices. You know, you can click on something you're already interested in or something that just catches your attention because it's trending a lot. The larger the bubble, the more it's trending. Okay, the larger the circle. So, you know, maybe Microsoft is something that interests you, and you see it's one of the larger size circles, so you click on it. Okay, it gives you not just the fundamental news. You have a trend analysis here. The prediction is the price may rise 8.7% on Microsoft. And you could say, okay, I'll take that into account on my trading strategy. What's the trend analysis from? This is from the analysts at Trading Central. You could say, okay, that's maybe in my favor if I was buying on Microsoft. There's a prediction here, it should rise. You can click on this and look at the technical analysis that's outlined for you. It looks like there's clear sailing, technically speaking, until this reaches the next resistance levels on the chart up in this price range here. So that's the prediction to where this could rise to these resistance levels up higher. So you've got the breakdown from a technical perspective that you can read through and look at on the chart. And then on top of it, you can take into account what you already know fundamentally. Hey, the markets have been kind of bullish. The CPI data out of the US and the jobs data has kind of relinquished some of the fear about inflation and interest rates. And so that's been on the side of some of these tech stocks being able to rise. So you start to put together a checklist saying, okay, the overall fundamental news on the markets is kind of in favor of this to go up. The technical signal says it should rise 8.7%. Then you can start to look at some of the recent articles and see, is there positive news or negative news coming out about Microsoft? Okay, and so you can start to read through articles that include information about Microsoft here. And if you want to read the whole article, you click on it. If you want to see a synopsis, you can read just a small summary as well. Okay, so if you click the link, it gives you a little summary, synopsis of the article. And if you click story continues, it'll load the web page with the whole article to read through. And so let's assume you read through some of these articles and you say, wow, recent news has come out that's positive about Microsoft as well. Maybe you find a couple stories here that sounds like there's positive news. And so then now you've completed maybe your checklist that, hey, when the market opens in the US, if I like the entry point and the trend on the chart, then maybe I'll follow this signal because maybe the fundamental news you think is in line with that. And now you're ready to make a move based on the totality of the information with combining these different tools to convince you. Okay, so it's nice to combine the technical analysis, the trend analysis with the recent articles and with the overall sentiment of the markets, in this case from less fear about interest rates in the US, and then have all of those in alignment to say, okay, now I really feel like I should make this move. Okay, and the last part is when the US market opens, you can check where is Microsoft. If you had sold yourself on wanting to buy on that, now it comes down to entry point. What kind of price are you going to get? Does it look like it's uptrending? Is it above, in this case, the pivot line that it says it should stay above if it's truly a buy signal? They're saying it shouldn't break below this line. If you read the instructions, it tells you if it breaks below 400 in this case, then they're saying you should sell and look for further downside. So you can combine the signal with what you know about the fundamental news and then make an informed decision to sell or to buy. In this case, it might be to buy, depending on how the market opens and if you read a couple of these articles, what you think. Okay, and we can do that really for any instrument, whether it's a stock. If you're in an area where you can trade cryptocurrencies, you can find recent news about the crypto market in general or about specific cryptocurrencies. And the same if you're a commodities trader, etc. Okay, we have natural gas, gold, crude oil, everything's here to be able to find recent articles and see if there's anything that catches your eye that might help convince you whether you should buy or sell. Again, trend analysis says a rise of up to 6.7%. You could read some articles to see, is there anything about the gold market that might tell you, hey, maybe I should buy or sell on gold, or any instrument that you decide to look at in the market buzz. Okay, and then one other area that is nice to look at is the news feed, which is found here, right above the discovery section. Here is a news feed. If you click on that, it summarizes the news for you without you having to check the articles in the market buzz or to check the recent economic announcements. You can look directly in the news feed, and this is summarizing everything that's going on in relation to these instruments that you might want to trade on. Okay, in this case, they're showing the Australian USD and the Euro USD that might be connected with this news. Okay, you know, why would the Australian be related to this? Well, we're talking about crude oil, and export of commodities out of Australia is a big thing. So many times they say as China goes, so goes Australia, because they sell so many exports of commodities to China, a lot of it energy related. So this news has been deemed to be connected to these pairings for a reason. Okay, so you can read the news, see if you feel like that fundamental news convinces you of something related to these instruments or other instruments. They're just suggesting these couple instruments. Certainly this news could be related to crude oil, could be related to other things as well. Okay, so very nice way to find summaries of what's going on surrounding different instruments that you might be interested to trade on. Okay, saves you time. It organizes it for you. I mean, look at the headline: crude oil rebound towards 79.40 expected. You could read about why they think that, and you could potentially make a move if that convinces you. And then obviously you can also look at the technical analysis on the chart. Okay, maybe this fundamental news makes you think, hey, I should buy. Then you say, but let me check if there's a signal on crude oil. So I can come here, pull up crude oil. The chart loads, and also up here, I see there's a live signal on crude oil. So maybe the fundamental news has convinced you to buy on crude oil. Now you want to look at the technical signal. And you see the technical signal says buy. Okay, but it also says the market has already reached a key level. What happened was it broke below the pivot. And the rule with these signals is if the movement breaks to the other side of the pivot, then the original signal is off. So no longer is this a buy signal. This is now a sell signal with take profit suggestions down here. Okay, so in this case, the technical signal is showing you to sell because this broke below the pivot. And the only way this would be a buy signal is if this breaks back above the pivot. Then they would say, okay, the buy signal's back on with take profit up here. So the way I would read this is, if the fundamental news told me to buy, what the technicals are showing me, it's a downtrend now, I might put a pending order above the pivot line, and I'll only buy if it breaks back above the pivot and hits my entry price on my pending order. Okay, and so that plan is put together with a combination of facts from the news feed. The headline saying, you know, crude oil expected to rise to a certain price. If I read the information and I think that the news in that news feed tells me some things that convince me that crude oil should rise, then I look at the technicals and I say, well, the technical failed for now. So the last part of this plan then is, based on this technical setup, is it makes sense to put a pending order above the pivot so it confirms an uptrend again before I would buy. So the technical signal is in my favor if it reaches the price in my pending order. Okay, so I might say buy, but I'm only going to buy if it rises to a certain price. So I would say execute when price hits. And if it hits above that pivot line, maybe it hits 79 or wherever I deem it's broken above that pivot line, then I get in, and the headline said something about, I don't know, 79 something. So maybe I decide I want to take profit at 79.90, and that my stop loss would be back below the pivot wherever I decide that price is. Maybe it's 78.50, and then I adjust my trade size so that I'm risking the amount I want to risk. Okay, and so very simple to do the risk management in the order window. You see, as I'm putting the trade size, it's telling me how much I'm risking, how much I'll make. Again, if I look at the signal and my pivot line is here at 78.50, or it looks like 78.40 is what this pivot line is, then I know I need to be above that with my pending order if I'm waiting for the uptrend to continue. So 78.40 is the pivot. Maybe I go 78.75, and that convinces me to buy, because then it would be an uptrend. My take profit up at 79 and change, like the headline said, is maybe expected to occur. Maybe I'll do 75. My stop loss back below the pivot, 78 flat maybe, because the pivot was at 78.4. I've got a little better take profit than possible loss. Now I need to adjust my trade size to be the amount of profit and loss that I'm comfortable with. If I want to risk, say, 1% of my balance, then that would be around 640. So I need to lower my trade size a little. See how easy it is to risk manage once you set up your entry points and exit points. 0.9 trade size gives me a risk of 675. 0.8 gives me a risk of 600, a little less than 1% of my balance. 0.85, right around 1% now. Going after a larger possible profit than loss. I've got my exit point on my stop loss and my take profit, those exit points based on the technical analysis from the signal. And if this goes up and hits above that pivot line from the signal, establishing the uptrend again, then I buy. Okay, that's just an example of a trade you could set up based on the tools that we looked at. Okay, and so I'll let this one run. We'll see what happens. I didn't read all of that information about crude oil, by the way. Normally I would if I was really going to trade on a real account. This is kind of a dummy account for me. So you would want to read that news and see if that convinces you to buy fundamentally. I know the headline said buy, said it was expected to rise. So I'll just assume that the fundamentals are on our side here. A weakening USD does help commodities rise against it. So we'll see how this one carries out. But the point here isn't for you to buy on crude oil with this example. It's to understand the process of what we just did. To look using these tools at the fundamental news, read through it, take the time to read what it actually says. And then if the technicals are in your favor as well with the signal, with the trend analysis, then perhaps you make a move, okay? Any questions, comments on any of this? Okay, and yes, you can use AvaProtect on gold, silver, and FX pairings. It's not available on crude oil, but if we're using one of the instruments where it is available, if we're looking at gold, for example, instead of crude oil, you'll see the option for AvaProtect as well. So if you wanted to make a market move, and instead of just putting a stop loss, you wanted to pay for protection, it's a small fee for protection, depending on your trade size and your balance. If I'm doing a tenth of a lot here, it's only $47.60 to trade on 10 ounces of gold. We've all seen gold move $20, $30, $40 an ounce in a short period of time. So you could easily make back $47.60 with a 10-ounce position on gold. $5 movement, you've made back the cost of the protection. And you can protect by the hour, even by the day. Okay, if I do 2 days protection, that takes me through till Monday. I'm protected till Monday with 10 ounces of gold. Gold could easily move more than $14 an ounce in my direction by Monday. Okay, the protection ends at this date and time, 2 trading days from now. It doesn't count the weekend days in this, so 2 trading days. That's all the way to Monday from now. If gold goes the direction that I pick, whether I'm picking buy or sell, I'm only risking the cost of the protection during this time period. If it goes flying the wrong way, I don't lose anything from that. Any negative floating when the protection ends, or if the trade closes during the protected time period, all of that negative is added back from the protection. And I'm only down the cost of the protection at that point. So a unique way to protect your trades, besides the fact that you can calculate your possible profit and possible loss here as well, depending on trade size and strategy. So very nice tools to use to help you with risk management, as you also use the fundamental news and the technical analysis to guide you in trading. Okay. All right, everybody, thank you for joining. Hopefully you can take a look at the announcements that are upcoming. I think we'll have some nice movements on the charts, especially with those US announcements today, and a number of announcements tomorrow out of the EU, US, Canada, etc. So good luck with your trading, and if you use these strategies, give yourself some room to test them. If you're using announcements to trade like we were showing, don't do it once and decide based on that. You can try small trades 10, 20 times using this type of strategy on the economic calendar or with the signals, etc., and see how it carries out over a longer period of time. And you can even do that on demo account, by the way. Don't have to risk your real funds to test your strategies and see, after you get a number of data points with a number of trades, how is each strategy working for you? And then you use what works best. All right, everybody, thank you for joining, and good luck with the trading the rest of the week. Bye for now.